Hi everyone, welcome back to Corporate Decoder, the place where we decode the financial jargon and uncover the real stories behind company reports. Today we're diving into Lord Abbett Private Credit Fund S, and let's just say they've been busy moving and shaking in the private credit world. So what exactly did they just report? Well, they've been out there raising capital and making new loans to companies that need funding. Think of them as a private bank for businesses that aren't publicly traded. First up, they've sold a bunch of their own shares, about 3,188.35 of them, raising a good chunk of money, around $8 million. They sold each share for about $25. This basically means they brought in more money to then lend out to other businesses. It's like a fund getting a cash injection to go out and do more business. They did this through private deals, so not everyone could buy, and which is pretty common. They're saying these sales are allowed because they're being careful about who buys them and how they're being sold. Now, let's talk about their actual investments, the companies they've lent money to. This is where the real meat of the report is. As of the end of July, they were involved with 23 different companies they've loaned money to, and they also have a stake in a joint venture, a business they've partnered on. In total, they committed to loan out about $28 million, and it actually loaned out about $222 million. This shows they're actively deploying capital. What kind of loans are they making? Well, almost all of it, 94%, is what they call first lien debt. That's super important. First lien means if a company they'd loaned money to runs into trouble and can't pay them back, these guys are at the front of the line to get their money back. They're the first creditor to get paid before anyone else. This is a much safer kind of loan compared to loans where they might be in the middle or at the back of the line. And get this, 100% of the debt they've loaned out carries floating interest rates. This means the interest they earn goes up or down depending on the overall interest rate environment. In a rising rate world, this is generally good for lenders because they can earn more. And the cherry on top, 100% of their loan commitments are in private senior secured loans. This reinforces what we talked about with the first lien debt. These are loans to businesses that are secured, meaning there's collateral if things go wrong, and they're senior, meaning they get paid back first. This tells us they are playing it relatively safe and prioritizing getting their money back sick. Now, let's look at some key metrics that describe the health of the companies they are lending to. The companies they lend to have a median EBITDA of $72 million. EBITDA is a measure of a company's operating performance before interest, taxes, depreciation, and amortization. A median of 72 million means half the companies have more than this and half have less. It suggests they're lending to fairly substantial businesses, not tiny startups. Their weighted average net leverage is 4.6 times. So for every dollar of EBITDA these companies generate, they have $4.6 of net debt. This ratio tells us how much debt a company has relative to its earnings. A lower number is generally better, meaning the company can pay off its debt more easily. 4.6x is a moderate level. It's not excessively high, but it's not super low either. It means the companies they are lending to have a good amount of debt. The weighted average loan to value is 41%. This means the amount they are loaning is about 41% of the estimated value of the company's assets, or the total enterprise value. A lower loan to value ratio provides a bigger cushion for lenders if the company's value drops. So 41% is a healthy number, indicating that there's a good amount of equity or value in these companies beyond what's being loaned out. Their weighted average interest coverage ratio is 2.3 times. This means the company's earnings before interest and taxes are 2.3 times what they need to pay in interest. A higher number here is much better. 2.3x indicates that these companies can comfortably cover their interest payments with their earnings. If this number were closer to 1 or below, it would be a serious red flag. And perhaps most importantly for Lord Abbett, the weighted average yield on their debt investments is 9.7%. This is the return they expect to earn on the money they've loaned out, before accounting for any defaults or other costs. A yield of 9.7% is quite attractive, especially when you consider the relative safety of their first lien senior secured loans. It signifies a good return for the risk taken. Now let's look at some recent activity. In July, they made new investment commitments totaling about $6.6 million. And again, all of this was in private senior secured loans or that joint venture. This shows continuous activity in growing their loan book. Digging a bit deeper into those July commitments, we see they put $1 million into Ambient Enterprises Holdco LLC, and they have a $5.6 million investment in a joint venture called SBLA2 Private Credit LLC. This joint venture is with Stifel Bank and Trust, and it also focuses on lending to other businesses. It's interesting to see them partnering up to expand their reach. Looking ahead, they've announced a distribution to their shareholders of about 21 cents per share. This means they are returning some of the profits generated from their lending activities back to the investors who funded the fund. And finally, their net asset value, or NAV, as of the end of July was around $102.3 million, and their NAV per share was $25.10. This is essentially the total value of all the company's assets minus its liabilities divided by the number of shares outstanding. It's a key indicator of the fund's overall worth per share. They also add a disclaimer that final numbers might change slightly once all their internal accounting checks are done. So what's my take on all this? Well, Lord Abbett Private Credit Fund S appears to be running a pretty solid and focused operation. They're prioritizing lower risk investments like first lien secured loans, which makes a lot of sense in the current economic climate, especially for a fund that needs to provide stable returns. The loan to value and interest coverage ratios of their portfolio companies seem healthy, suggesting these businesses are generally well managed and can handle their debt obligations. The 9.7% yield is very attractive and indicates they are finding good opportunities in the private credit market. The major risk here, though, is always the credit quality of the underlying borrowers. While they're focused on secured loans and companies with decent leverage ratios, a significant economic downturn could still lead to defaults which would impact the fund's returns. Also, the fact that it's an emerging growth company means they might have less established track records compared to larger, more seasoned funds, so keeping an eye on their performance consistency will be crucial. Overall, it looks like a well-managed fund that is actively deploying capital into relatively safe but rewarding private credit investments. They are growing their capital base and seem to be generating good yields for their investors. Alright, that's our breakdown of Lord Abbett Private Credit Fund S's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.